Good morning, everybody. Welcome back to the Schwab Coaching Channel. I am your host, Kevin Horner, for Trader Talk in today's market. Happy to be here with all of you. Thanks for joining me today. Please take a minute and say hello to my friend Ben Watson there in the chat today. Ben's going to keep an eye on things for me for stuff that I'm unable to reply to in the moment, maybe some specific questions you might have about the usage of the thinkorswim platform, or maybe some additional questions. Ben will certainly address those for me, but of course, I want to hear from you, so please don't hesitate to utilize that Q&A to post comments and questions for me to address during the segment. I'll be happy to get to as many of those as I can. If you're not already doing so, take a second and follow Ben and me on X. You can do that for us each. Ben is Ben Watson CS, and I am Kevin Horner CS. Follow there is very helpful for us. You can engage with us that way outside of the classes that we provide on a day-to-day and week-to-week basis, though. Good way to follow along and see some of the charts and postings that we provide for you on the weekly basis there. And of course, if today's content is good for you, I'd love it if you'd hit that thumbs up button down below for me at the conclusion. I'll allow you to let the 45 minutes go and then hit that thumbs up. You don't need to be presumptuous here. Let's make sure everything is exactly as you hope. So with that, let me cover some disclosures and then we'll get into the fun stuff. First of all, remember that our conversations are only informational and educational. We are not making recommendations, of course, nor any endorsement for a particular approach to trading the market. We also want to point out, as we often do, we talk a lot of technicals here, everybody. In the terms of technical analysis, we're going to look at a lot of levels of support and resistance in many cases. But what we want you to think about with technicals is that this is really just a piece of the puzzle in your decision making. Do not base decisions exclusively off technicals. We often fall back on this idea that fundamentals can help us build a list of appropriate securities for investment, and then we can utilize the technicals to help us understand perhaps when it's appropriate to be investing in those stocks. So there is absolutely a relationship between technical and fundamental analysis. We just discourage you from basing your decisions exclusively on the technicals. As far as our agenda, everybody, it's going to be the same today, although today's class, we're going to spend a little more time on individual equities. It is a solo hosting session, which affords me more time to get to that. I also have an existing open trade on this in the account, the example portfolio, and I want to review that trade with you as well. So we'll start with the S&P, the NASDAQ 100, and the Russell 2000, hit up the semiconductors probably, and get to a boatload of stocks in the news. So a lot of individual equity charts for you today. Hopefully we set the table well on this Thursday as we head towards the end of the week. It is, as a reminder, thanks for bringing it up, Kay. It's the Super Bowl weekend. Can't say that I have a whole lot of rooting interest, but as a longtime AFC West fan, a Denver Bronco fan, I would be perfectly fine if the Chiefs don't win. We'll just leave it at that. Now, as far as the S&P is concerned, everybody, we have a little bit of a nice open here, trading up about 0.25%. What I find notable today, though, is look where that level resides above the downtrend line off the peak. We've got this channel that's been working after having created. So basically, we had this longer range channel that we broke from, and we did that, made moves to new highs. And now we've got this smaller ranged channel, and we're trying to get outside of it to continue our push to the upside. So if we're talking about initial resistance, sure, 6,100 resides above us, about 25 points away. And then we can see the prior highs there at 61.18 and 61.28 respectively on those back-to-back days. So that gives you another layer of resistance. Now, of course, we know that resistance does not necessarily mean we have to be beaten back at those levels, everybody. So a breakout through 61.25 currently would be opportunistic for the bulls and may signal more upside and a continuation of what has been a wonderful move here. It's really been, I'm going to go to a 3-year chart just to point this out, but it's really been since that most recent extended low was the October of 2023 bottom. And look at how great things have been in terms of percentage moves, everybody. If we went to that 61.28 intraday high off of that, you're looking at about a 49% move over the equivalent of about 18 months or so, more like 15, 16 months. A really wonderful move, obviously, in terms of both trend and percentage. But the reason I point this out is that if we were to find ourselves in a retreat mode, in a level, if we sold off and found ourselves at the 200-day moving average, for example, it wouldn't be terrible because we've been very, very good here. 49, almost 50% move to the upside. And if we found ourselves at the 200-day, well, suddenly that return is only about 38%. So it would reflect, a pullback that would be considered proper and appropriate. We do on average get that 10% pullback, once every 12 to 18 months. We certainly have had a bit more of a momentum-based move in the last 15 plus months here out of the S&P. So, at some point we're going to get one of those moves. Obviously, I don't know when that's coming, and not many traders do, but the process that we take on is to, as I often say here in this show, we want to know the levels where we want to move on, and then we adhere to those levels as they come to pass in the real action of the market. So, perhaps some traders will start to get a little bit defensive if we took out the low we made back here just at the beginning of the week. That's a possibility. But by the same token, if we push to the new highs, obviously there's not going to be a whole lot of bearishness as it relates to making new highs, everybody. So we'll see how that plays out here, but a good start on the S&P today. How about the NASDAQ 100? A little more flat. We don't have a whole lot of shift to what's going on here. We did talk yesterday with Brent Moores about the support at the low we created on Monday's open and how we've been a little bit optimistic because the price action might have been terrible on the open on Monday based on the notification of tariffs hitting Mexico, Canada, etc. But since then, when we got the notification of delays to said tariffs, we've had moves higher from that 20,000 or 21,000 level. I think that tells us that we've got good support in the NDX at that 21 level. And how about that? My trade here in Carvana, which we'll be talking about in a moment, just went off. So we're going to I'll explain what happened there. That's excellent trade. Absolutely. I can't wait to highlight that example trade for us and put a new one on. But as it relates to the NASDAQ here, things seems like we are kind of at an important spot, right? We've got this little bit of a gap coincident with those 3 days above the gap level. So if I can get my line to do what I need it to, there we go. So if we can trade through this white line at 21,720, well, now we can start to push higher. So let's see how we act there at around 21,720 or so. As you can see, we had that huge candle there last Friday. We tried to push back into that range, and it just did not maintain. And then we got thrown back. And of course, we had a talk on Friday a little bit around the potential for the tariffs to be hitting, and that led to kind of some of that selling on Monday and that terrible open on selling on Friday afternoon and weak open on Monday morning. Okay, so there's your NASDAQ. Now, yesterday's big move was in the Russell. It brought us back to the 50-day moving average, and we talked about needing to get above it. Well, looks like it, at least today off the open, we have pushed a bit higher, and it seems as though the fact that the rates are moving back up again, yields higher once more, interestingly, is not giving us the negative impact that we may have expected. In fact, yesterday, the talk around Russell was tied to the fact that the 10-year had retreated. We fell through what some would have said was major support, the 50-day moving average there. We're below it still, 2 days now. Some traders are calling out, as Brent did yesterday, the potential head and shoulder top here in yields. And if that is in fact valid, boy, this line that we've drawn in here becomes very important. Trades back above this level would be indicative of a belief that we've got more upside in yields, but 2 days below this level could mean a bigger move to the downside. That could be tailwinds for us in the broader market, particularly in the Russell 2000, those fairly interest rate sensitive areas of the market. So going to want to keep a close eye on this, obviously the yield itself and the action with the Russell. But I'm encouraged, and I think a lot of traders would be encouraged by the move to the new high. That is a short-term high. It's the highest we've traded since we broke down here in mid-December. And if we can maintain the 50-day for an extended period here, everybody, 2, 3, 4 consecutive closes, we may have an opportunity for more upside. But remains to be seen at this point. We like the improvement, but clearly we've banged our heads on this ceiling a few times in the last couple of weeks. So we need to clear it if you're looking for more upside. Okay, and then let's hit up the semiconductors. Off a little bit here. Semis are continuing that struggle. Yesterday, Brent and I covered the difficulty we've been witnessing and the fact that we remain below all three major moving averages. Sure, yesterday we closed above the 50-day, but now we're just right there yet again. So semiconductors, not as healthy as we would like. We're needing to get this thing back into trend. Right now, I think a lot of traders would basically tell you that going back to when we started breaking down in the summer of last year, really what we've seen is just a lot of choppiness as it relates to the semis, a lot of digestion and a lot of price discovery, and not really a whole lot of trend to work with here, everybody. It's a difficult current setup. Now, this should not be a huge surprise if we go back to something like the weekly and just look at the trend move that we saw. We really began the uptrend here once more the beginning of October, but this was October of 22. So the semis started their new uptrend all the way back here. Now, I can draw a few lines. We can take a line through this low and extend it, and that might give us a long range trend line. Okay. The other thing that I want to do is draw a line all the way to the peak, which is going to give us a little bit of an understanding of just how much digestion we really need, right? There you are looking at 181, almost 182% move. Fantastic by nature. Let's see if we can apply a Fibonacci level to create an area of potential importance for support. One of the ways we could do that, I'll just shift over to my percent sign here for Fibonacci retracements, and I'm just going to draw the line from that extended bottom to the extended peak. All right, so push that back up to 59.31. And then we're going to zoom in a little and just see if we can. Let me change this color so this stands out a little more for us. So I'm going to set the color here to how about purple? And this should make things stand out a little better. Okay, so what we're looking for is a potential area of confluence, everybody. That is to say, an area where support and a trend line and a level from a Fibonacci retracement standpoint can all come together. The interesting thing as it relates to this chart in the semis, I think the area that now stands out most is this one right in here. Now, I've got a rectangle on it, but really that rectangle could be much wider. For example, let me activate it, and I'll just increase the line. So what if we looked at this as the zone of potential support, everybody? That is an area to monitor. Doesn't mean we have to get there, right? Because we know that we've got a good zone of support right beneath us, so traders could work against that. But if we moved under about 47.50, for example, we could find ourselves down a few hundred points. And I think that bears watching. Again, I'm not suggesting that that's what's going to happen, but once more, have a thesis. Give yourself some ideas as to what could occur, where will you take action, and what will that action be? Very important to the trader to give yourself those steps, right? If you give yourself the playbook to take action, well, hopefully that leads you to making proper decisions rather than in the moment and hasty decisions. That's one way to give some consideration to it. Now, the other thing that stands out on this chart, and this will be the last thing I'm going to talk about as it relates to the semis, is the RSI down below. Now, RSI can be used just like many of our technical indicators and oscillators can be used in daily charts, weekly charts, etc. What I find notable on this one, everybody, is that we have been resistant to a level of importance here. Now, if you watch us talk about the RSI frequently, you know that in instances of bearishness, the RSI can push into 50 to 55, and it can find that to be resistant in lieu of 70. Remember, if we're going in a sideways market with matching highs and matching lows, a lot of traders will just lean into the RSI and say, when RSI reaches 70, that's overbought conditions. And as it crosses from 70 back below, that is a potential sell signal. And conversely, using the 30 line as oversold conditions. And if you cross from below 30 to above 30, at an area of potential support, that can be your opportunity to trade from the low of the range to the high of the range potentially. But what we're talking about here is letting us know that there's not as much bullishness from the semis here, because we can't get that RSI above 55 for any extended period. And so in the midst of bearish action, a level between 50 and 55 can act as overbought conditions on the RSI. And I find it notable that that has been occurring along with price action. So as price runs into 53.50, we are seeing the RSI meet resistance as well. So we're basically confirming the chop, confirming the resistance band up there. And truth be told, if you're bullish, fine, but you really are going to struggle to be bullish and have more upside until we can trade through that 53.50 area above us. Okay, so that's what we're looking for in terms of continuation opportunity on the semis. That was a fun chart, looking at that one on the weeklies. What do you say we make our move to individual stuff? So let's pull up the Carvana trade that I was just highlighting. So first of all, I'm going to pull up the symbol here. Now, my layers are notable. We had put on a trade back here on a hold move. We had been in an example scenario talking about the opportunity to join a new trend based on a pullback. And that's exactly what we got here. We added on this day, as you can see from my green arrow notification, it was a day where we closed above the high of our low day in the pullback. And so we had defined our low day in the pullback as this one on the 3rd of January. And we basically said, well, we had a wonderful rally. We met resistance. And if this level was going to hold, well, then we'd have an opportunity to target $260 a share. And that's exactly what we did, everybody. We put on a fairly small trade, only 25 shares, and we picked it up at 262 cents. And then we had a limit sale at 260, along with a stop exit below us should things break down. Well, the breakdown never occurred. And about a week and a half ago, maybe 2 weeks now, we raised our stop order, but our limit bracket order was out there as well, and it just got tagged today. So I had built this kind of broadly, right? I know a lot of you traders out there, you want to work with dollar amounts that are alternate or off the round figures. I had set this just fairly generically, not as concerned about it. But the fact is, we got to our target zone. We got out of the trade. We made a little more than 60 points on this trade, or a little less than 60 points, I guess, 59 and 60 cents it looks like, on 25 shares. Here's how that came out on our monitor page. So if I went ahead and pulled up our filled orders, let's go to the account statement here and put in, actually, I'll just change this to purple. It'll bring in Carvana. And then let's just go back. We got to go back a little more than 30 days, don't we? So I'm going to go back to January. There we go. And then that's just going to show you your order history. So there we are. We bought it on the 7th, and we had a bracket order for exit. And as you can see with today, we have moved on from that trade, but it worked out great. Had in terms of the strategy, the process worked out great. We know that's not going to work out that well every time, but I did want to highlight that because it did work out great for us in this scenario. It came out to almost 1,500 in profit on a fairly small trade. I mean, again, I want to remind you all, share amounts aren't as important, right? What is important? Dollars devoted to your trade. So always be thinking dollars in lieu of share amounts. Don't be misled in believing you need a lot more shares. You just really want to focus on the dollars. I think that's a big part of it. In fact, I should also mention that come to today, this afternoon, I will be also hosting a getting started with stock investing session. And today we're going to be, I believe, talking about position sizing. I really want to get into that. Position sizing is so important to the trader. So if you're looking for ways to build your trades and conceive of the math behind how many shares to own and why, this session this afternoon will be a good one to check out. So check that out on the calendar. I believe we'll be doing that for you at about 3 p.m. Eastern today. So pleased with the way that one went. Now, let me bring up some individual stocks in the news today, and we will look at those charts and see about building a new example trade for us going forward. Since Thursdays are going to be my solo day moving on for the rest of the year is my expectation, I'd like to utilize our Thursdays as a way to look at as many example opportunities as possible. So that we can really kind of hone our skills as traders and looking at examples and building examples into the conversation here can go a long way for us. So we're going to look at some of these stocks in the news and why they're in the news, and then that'll help us determine whether we have some example opportunities for consideration. All right, questions in the chat. Let me go back to that monitor. So P&L difference is simply the total differential amongst the portfolio. So profit versus loss from the beginning. I've only had the one trade in this example portfolio. I believe that's what we're looking at there in terms of differential. No, trade and grow. This is no longer the futures class. Let me point that out because this is the first week where we've made this adjustment to our schedule. Tuesdays is when you will find the futures class hosted by our friend Ben Watson in the chat, of course. So check Tuesdays for the futures discussion. We will be doing traditional trader talk Monday, Wednesday, Thursday, and then on Friday we have the non-archived discussion utilizing exchange traded funds for you. And of course, that one's with me and my friend James Boyd. All right, so let's look at some of these stocks moving around for you all today. Let's start with one that had a bit of a rough go. That would be Alphabet. Alphabet yesterday got thrown back to that 50-day moving average. I'm going to go into my settings and remove my historical trades in here just to limit some of the noise on my chart. Now, this is an interesting spot. I mean, yeah, sure, if you were bullish in advance of the earnings, you were feeling really, really good, right? But the earnings were a little bit of a miss and not wonderfully received there yesterday. But if you're bullish, are you intrigued or maybe pleased by the fact that the selling to this point was halted at the 50-day moving average? That is a potential spot for entrance. And when you look at the level of some of these tails in here, maybe some traders would look at that 188 ledge. And if you're feeling like the action around the 50-day moving average affords you a good risk versus reward opportunity, some traders might choose to step in here and place an exit strategy under 187, believing that moves down to 180 through 187 to the downside. That could bring you down to the next ledge of potential support, and that might be this gap zone right about here, which, according to my math, would only be about another $5 or $6. But that doesn't mean it's comfortable for all traders. So as always, do the math on that. Are you the owner or holder of 100 shares, which would mean a $600 move to the downside potentially, or maybe you own only 10 shares and you could deal with $60 to the downside. No big deal. It can all matter, right? So do the math, know where you stand, know how you want to act. But if you're, like I said, if you're bullish, you're not aggressively disgusted by the 50-day moving average coming into play as potential support here. Sure, continuation of the move would have been great, but nonetheless, a decent spot for support for many traders. Now, today's headline on Alphabet specifically actually applies to both Meta and NVIDIA as well, in the sense that lawmakers are planning to introduce some legislation today that would bar DeepSeek, the chatbot and its application, from being available to government-owned devices due to security concerns, of course. So this is a potential way to boost or lift NVIDIA, Meta, Alphabet as well. So give some consideration to that, everybody. Also, I wanted to highlight a chart here on Honeywell this morning. I spoke about this very briefly today. Honeywell is preparing to split into 3 independent companies following similar moves by General Electric, among others, according to Wall Street Journal reports. Now, Honeywell plans to separate its aerospace division from its automation business, moving ahead with plans to spin off its advanced materials arm, according to the Wall Street Journal. So these moves are the culmination of a portfolio review that Honeywell's board and their CEO, Mr. Kapoor, launched about a year ago, and the company's been under pressure from some activist investors, notably Elliott Investor Management. So there's been some discussion about ways to get the position to look a bit better. Now, what I found notable about the drop here is the level to which it fell, everybody. Let's pull this back and take a look at what's been going on. Remember, we talked about that October 23 bottom in the S&P 500. We see the same thing as a bottom in Honeywell. And if you wanted, excuse me, if I wanted to draw a line through some of these lows, we could say that we've been in a bit of a channel over the last 15 months, right? So check this out. If you are thinking that this pullback, it might just be opportunity to participate in the channel, well, you wouldn't be terribly offset from that, would you? You would not necessarily be wrong. You could absolutely see why we might be bouncing where we're bouncing here, right? So that's a potential area for support. It is a bit of a pullback. And by the way, I should also point out, initially this was well received. Honeywell was up 6% off the notification, and then it had a 12% reversal all the way down to 208. So sold off $30 very, very quickly, and it's trying to get itself figured out here now this morning. But wanted to bring that one up. That one could be a potential example trade for us, everybody, because again, the risk reward scenario here could be proper for the bullish trader who believes it at least has upside. I mean, let's look at it very generically. Let's zoom in. And what if we thought it could get back just to the level it fell from, the 50-day moving average? That seems reasonable, right? So let's just put a line in there somewhere. How about right about here? So that's around 225. So if you're a buyer now at 213, you have about 12 points of potential upside initially. Doesn't mean it can't go higher, but that's how a trader might think about a bounce opportunity here from an example standpoint. And if that trader was looking for what could be 12 points of upside, well, then we need a proper amount of risk. About 1/3 of our trade profit opportunity is a comfortable spot for a lot of traders. So if we're looking for entry at 213, willing to risk maybe $4 for the profit opportunity of 12, that can fit from a risk to reward standpoint. So potentially here we could do a Honeywell example with about a $4 tolerance for risk and about a $12 upside target. That's a possibility. Another one I wanted to peek on today is Skyworks. We got to look at Skyworks, everybody. Unfortunately, Skyworks got hammered on the earnings. They have been downgraded by a number of companies. B. Riley has downgraded Skyworks to neutral from buy. They dropped their price target dramatically. 110 dropped down to 65, everybody. The company announcing an historic share loss at its number one customer in the next generation iPhone model in Q4. And then simultaneously, they announced the unexpected departure of their nearly 10-year CEO, Liam Griffin. So amid a multitude of uncertainty, things are not great for Skyworks. Mizuho also downgraded Skyworks, have been pushed to neutral from outperform. New target is 62, down from 105. Stiefel also downgraded Skyworks to hold from buy. New target again, 62, down from 105. This is all for the, in terms of price target adjustments, everybody, it's the loss of Apple as its largest customer, and it's really created a massive issue for Skyworks. So this is a huge deal. The biggest reason it's a huge deal is I can't get away from this chart, everyone. Look at what we just broke from. We had this very lengthy consolidation right in here, and now that was about 85 to 1, let's call it 120 for easy math. That's a 35-point range that we are breaking from under 85. Measured move target suggests potentially 50. Now remember, measured moves, what are measured moves other than just calculation? They're approximations and targets that traders might choose to use, is by no means a guarantee that that is the amount of falling we could witness here. If it were, it would mean about another 15 points potentially, but as you can see, there does seem to be quite a bit of support at some lows here where we have just gotten to today. So this bears watching, of course, but we don't like what we see from a stock that had been doing so wonderfully alternatively. I mean, in the, what I say wonderfully, had been going really, really well from 2019 to its peak in 2021. Man, this looks really, really long range, like it has to hold that 60 or maybe 57, 58 level. Just a really terrible breakdown, unfortunately, here, everybody. That's just not cool at this point. Let's see. I think I have some news on CRM. Oh, okay. Yeah, I did. Let's pull up Salesforce and take a quick peek. All right, so Salesforce is off about 4%. Going back to the 20-day moving average and a little bit of horizontal support in here, everybody, right? We've got some tails at that 330 level. The news I have here is that the Doge staff of the U.S. government were ordered to stop using Salesforce's Slack application while transitioning from the Office of Management and Budget to the Executive Office of the President, which is not subject to the Freedom of Information Act, which is a records transparency law, of course, commonly used by journalists and lawyers, etc. So that's why you might be seeing a little bit of weakness here as the essentially the order to eliminate the use of Slack in the Doge staff side of things in the U.S. government. Now, again, you've had a brief downtrend that was corrected. It was a little bit steep, admittedly, but once corrected to meet matching highs up here, it's setting up higher lows. So perhaps the trend can continue on CRM and Salesforce here, but that level at 330 does appear to be pretty darn important at this point, doesn't it, everybody? Moves through 330 to the downside, we could once more be looking at matching up with the lows we just made around 315. So not a huge move, another 15 points on this one. That'd be about, 5% or so. Not great, but, you've got some areas of note. And surely some traders in here are going to be looking at that 330 ledge to provide that support. All right. One other look is at MicroStrategy, now to be known as simply Strategy. Yesterday, Strategy has come out and suggested that they are going to be rebranding as simply Strategy going forward. They are now maintaining 447,000 Bitcoin, approximately just shy of 24 billion in asset value. Their position for the full year of 2024, the company's Bitcoin yield was 74%, fantastic return. Now they're revising their 2025 targets to achieve an annual Bitcoin yield of more than 15%. Now for the full year of 2024, the gain was about 140,000 Bitcoin. The company's 2025 target is to achieve an annual Bitcoin dollar gain of $10 billion. That would be tremendous. So adjustments according to analysts, everybody. We heard from Canaccord analysts lowering the firm price target on Strategy to 409. Previous target had been 510. They are maintaining their buy rating on the shares. The firm said the company's 2025 setup is continuing to push the envelope on corporate treasury strategy by acquiring Bitcoin while noting an upped Bitcoin yield guidance framework, as well as the successful preferred stock issuance and the corporate name change from MicroStrategy to simply Strategy. Okay, so there you go, everybody. That's all we have as it applies to MicroStrategy. Now, the interesting thing from the chart standpoint, today is day 9 below the 20-day moving average. And for a lot of traders, holding the 20-day is great as long as you hold it. And then when you get back above it, you've got opportunity. But what stands out on this chart, everyone, if we were bullish all along the way because we held the 20-day, well, then we broke the 20-day and you had to get a bit defensive, right? We were okay. We came down and we had a little test of this gap zone. In fact, looks like we almost filled this little gap in here, right? Came close, but not quite. But we bounced off of it, recaptured the 20-day for about a week and a half, and now we're back below it for almost 2 full weeks. So that stands out to some traders, everybody. Does it mean we can't move back higher? No. Of course, we absolutely could. Does it mean we have to test a zone of support? Potentially. I mean, if we got back down to the lows we've just created and tested again, if we tested 290 once more and hold, that could be the impetus for new bullish traders to come in. But unfortunately, under 290, things could get a little bit dicey, and that bears watching because percentage-wise, if we were to see the 200-day moving average, it would not feel great, would it? It would be about a 24% pullback to the 200-day moving average just from support. That's not from where we are today. So you would be feeling it. Now, yes, Chris, I won't dispute your view. It does seem like a bit of a coil in here or a consolidation, right? Certainly a possibility. It's a little easier to see in some cases on the weekly chart, and that's cool. I mean, you could absolutely be right. And if you're right, my thought is, where will you position yourself and what price action would be the key delineating factor in going long a position like this? If it is, in fact, coiling and this is giving the appearance of a long-range bull flag, well, when does the trader take that trade? If you're aggressive, an aggressive short-term trader might take it on a break of this line, right? Let's make this a red line so it's just very clear. You'd almost have to trade above that red line on a closing weekly basis to believe in a breakout here. Some traders would take it on a break of a downtrend line and then add if we closed above these highs around 400, because a close over 400 would give you, in the short run, higher highs. So could there be opportunity between 333 and 400 for the short-term trader? Of course, but it's not necessarily as comfortable as it might be if the trader were to be patient and allow a break of the downtrend line, because while we might run into that downtrend line and we have the potential to add 50, 60 points or more from here, it's just as potentially available to us that we continue rejection in the short run at the 20-day moving average. And what happens if you take position today believing a breakout's coming, but we don't get it. And then now you're working lower and you're suddenly thinking, okay, I've got to have that 290 hold for me. Unfortunately, 290 is 40 plus points away from where we are right now, right? So does force you to put some different levels that might be more difficult to locate on the chart, okay? So keep that in mind as well. All right, so we only got about 5 minutes to go, everybody. I do want to get an example trade on for you all. So based on what we've seen in the way of the charts and the news headlines on these individual equities today, I really think that the one that stood out the most from the opportunity standpoint, the pullback in trend, I think it's the Honeywell trade. Let's go back to HON. And just given where we reside in the channel, if this is going to continue, well, then maybe we have something to work with. But let's make it nonetheless, let's make it a short-term trade, and let's just go with the potential for a relief bounce back into the 50-day moving average, potentially that 225. So I'm going to put that here with the red line so that I'm going to give myself something to monitor. And in terms of placing the trade, we would be fine moving on for about a $4 loss based on our approximation of about a $12 potential upside move, right? So again, you don't always have to use an area of true support, what you deem to be support. It can absolutely just be a mathematical relationship between your profit estimate and how much you really want to risk. So while I was building out a risk reward of about $1 of risk for $3 of reward, that puts us at what might seem to be a fairly innocuous level, right? If we buy at 213, I might put an exit at 209. Now, this case, that actually coincides with potential support. And one thing we don't necessarily as traders want to do is place our stops on support. So perhaps we need to be a little bit below this, because moves through this 209 could get ugly, being that this is a nice little spot for support. So let's go under 209 by just an extra buck. Give us a little bit of an a little bit of a wiggle room here. And if we take it down to 208, yeah, we'd be risking about $5 for our potential exit at 225. So let's build that out with a right click and a buy custom with OCO bracket. So as an example, once more, we're simply buying with an entrance immediately. We'll do that as a market buy. We are then going to change our exit strategies to good till canceled for both a limit sale and a stop sale. So first thing we're going to do is make an adjustment to the number of shares. So let's do 25. Yeah, 25 shares is perfectly appropriate in terms of the size of the position. Not a huge trade. It's going to be a little more than what? 10 shares would be a couple thousand. So 25 will be about 5,500 or so, ballpark. So we'll be buyers at market. Our exit strategy to the downside, if we get under 208, we'll move on. So let's just set a round figure 208. Remember, some of you want to go to non-round figures. You want to be off the dollar. So perhaps it's maybe 207 and 95 cents or something like that. That's, trader's choice. Make your decisions on that, everybody. And then on the upside, we said we might get back to the 50-day moving average around potentially 225. So 225 in there. So we'll buy at market, and we'll have a subsequent exit at 225 or 207.96. Because these are one cancels other, only one side of that trade can execute. And again, we're doing this as an example trade for our example portfolio. I'm going to quickly review the details. Buying 25 Honeywell at market. Our subsequent sale will either be at 225 on good till canceled. That's good for six months. Or selling to the downside with a stop at 207.96. Also good for 6 months. Reminder, we might trigger below 207.96, and we get a market order to sell when we have a stop. That means if our trigger is not 207.96, but maybe we gap below it and opened at, say, 200, well, then we're going to have a market order to sell, and it's going to be pretty close to 200. It's not likely to be close to 207.96. So heads up on that. Remember, the stop order is not a perfect order, okay, since it triggers and becomes a market order to sell thereafter. So I'll send that one off. We'll get our execution, and now our exit orders are there. So we covered quite a bit today. I hope you all enjoyed it, because I really do like the single host session. The solo session allows me and affords me the chance to look at a lot more individual equities and maybe some more example opportunities. So I'm hopeful that this is going to be a bit more aligned with expectations for you all going forward on these Thursday classes. So I'm really glad you're all here. Thank you so much for joining me today. Big thanks to my man Ben in the chat. Looking through the notes. Yeah, options might have been an opportunity for you there, Bob, and the Honeywell. That's certainly a possibility. Yeah, lots to look at here, but we'll revisit this obviously next week in the hopes that this has bounced for us as opposed to stopping us out. And so with that, thanks for being here, everybody. Hit that thumbs up button for me down below. I'd really appreciate that. And don't forget to follow Ben and me on X. Keep it tuned right here to the Schwab YouTube coaching channel. Much more coming from us today. I look forward to seeing you all again real soon.